Welcome to the Thursday edition of the Not Your Average Investor Show. Today, we're talking about this idea that rents have just skyrocketed over the past couple of years, right? Like they are way up over the past few years, especially here in Jacksonville. And as investors, that's awesome. But we have a question of like, how long-term is that going to happen? How long is that going to go? How long is the party going to last? And then the other question that not an average investor asks is, who's this party good for? Who's invited to this party, right? So we're going to just talk about how this stuff is happening, why, how long it's going to go, how it'll affect your investment, and just as importantly, we're going to talk about how this can actually be a good thing for the entire community. I'm your host, Pablo Gonzalez. With me, as always, today here next to me, able to be affected by my fake laugh,
that is true,
is the man that I like to call GC because of his genius concepts, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you today.
Hello, everybody. I feel like you've started inflecting that a little differently.
I'm going strong with it.
I'm a fan.
Because it's becoming my thing.
Is it because you've been watching Seinfeld and you saw that episode where he does that voice?
Yes, that's a good one. I was going for Mrs. Doubtfire. That's what I was channeling.
Welcome to the show, folks. And if you like this type of stuff, being in a room with Greg, hearing him say hello in person, and the fake laugh, which I promise is better in person, I just found out.
It is.
Then there's something happened on February 16th and 17th that I think you're going to like. What is it, GC?
Yeah, we've got the Not Your Average Investor Summit coming up on February 16th and 17th. The great news is that we're having the summit, and those who are already signed up are going to have a ball. It's going to be a fantastic event. The slightly bummer news is that we're sold out. So if you haven't been able to sign up for it, we're sold out right now. But then the little bit of sprinkling of good news is that we do have a waiting list, and we would highly encourage all of you who would like to be a part of this event to go to the waiting list. And we are doing our darndest to make sure that we can accommodate as many as possible. So go to the waiting list, go to jwbsummit.com and sign up if you haven't signed up for the waiting list yet. And there's a lot of information for all of you who are coming. Parking, hotels, other logistics right there at jwbsummit.com. And we can't wait to see you.
The thing about the waiting lists is that we're trying really hard to accommodate in two ways. One is how many people can we like expand to and, you know, maybe invite a couple people off the waiting list. Two is I'm leaning really, really hard on Greg. As this waiting list grows, I'm leaning real hard on GC over here to have a second event. So if it's something that you really want to be a part of, please don't say, man, it's already a waiting list, I'm not going to get in. Help me help you by adding sprinkle a little pressure on him right here to see if we do a second event this year. I'm for it. I want to hang out with people as much as possible. It's a big lift. It's a big ask for the JWB team. So we just got to show them that it's wanted by the people. So just come sign up for the waiting list at jwbsummit.com. And if you've already signed up, man, it is only getting cooler by the day. The agenda, what we're going to talk about, the people that are coming. I'm getting really, really excited. I cannot wait. I just got a text from Lee Bishop saying that he just booked his Airbnb.
Love that.
We're going to go grab dinner and blah, 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 blah. So there's going to be a lot of cool stuff happening. Hope to see everybody there. jwbsummit.com, February 16th and 17th. And when you go, you get to answer the age-old question. What do people look like that we call out in what, GC?
The roll call, baby.
We got the MVP in the house.
Lee Bishop, of course.
You've heard of him. We got the leadoff hitter hitting second today.
John Henning.
We got the Shaw man of the community.
Nadeem Shah.
We got our regulars, Gary and Rosalind Riley from Murrieta, California.
We regard you.
We got the Maven in the house.
Leslie Wilson.
We got Mama Bear saying, hey, everyone.
Miss Cody Adams.
We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, 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 dun.
We got the 5 Fs, our favorite flat fee, fiduciary, financial advisor, friend, the 6 Fs. Kelly Barenbaum in the house. Good to have you.
Can't wait to see you, Kelly.
We got Pamela Meyer. She's back from the Seattle area. I think Pamela's coming. I don't remember.
I hope so.
I hope so.
It's great to see Pamela. She is here, I think, each and every single show. So thank you so much for being here.
2024 is the year of Pamela. We got Joel Wixel in the house from Santa Barbara.
All right, Joel.
You ever been over to Santa Barbara?
I have not.
Oh, man.
You
it's so
love
nice.
that place.
I actually have a friend coming to visit. She just texted me who used to live in Santa Barbara. I haven't seen her in like 20 years, and I love to surf in Santa Barbara with her. But I'm hanging out with her this weekend.
Nice.
Going surfing.
There we go.
Love Santa Barbara. All right, who else we got in here? The ringmaster.
Drew Barnhill.
Drew Barnhill. Vincent Barber from Strong Island out here.
Speaking of another individual making time to be here each and every show, Vincent, great to see you.
Love it. The patron Santorios of Northern Virginia and the Not Your Average Investor Show.
Michael Santorios.
Michael Santorios in the house. We got our amigo in the house with a Feliz Jueves, amigos.
Bill Shields.
Bill Shields, good to have you. We got Big Papa in the house. We love it when he calls it Big Papa.
Pops, how are you, man? Good to see you.
The co-founder of the co-founder, Jay Cohen. All the early birds here a little late, but he's here.
And we'll count on it. Dean Curry.
Dean Curry, 14 days until the summit. He was
I love
the first
it,
to
baby.
sign up, as we all know.
He's the early bird.
He's the early bird. We got Eric Killo in the house.
Ooh, new name.
New name.
Welcome to the party.
All the way from Blooming Prairie, Minnesota. That sounds delightful.
He should say hello to Lita. She's from Minnesota
That's
too.
right. Lita's up in Minnesota as well. I don't know how close to Blooming Prairie. Maybe she's in already bloomed prairie or a lake or something like that. But I'm sure it's a wonderful place. It sounds delicious. Scott Richardson in the house.
All
Good to
right.
have you, Scott Richardson.
Is that a new name?
I think that's a new name.
All right, Scott. Welcome.
Welcome to the show. Jeff Pettyjohn, not a new name at all.
There we go.
From Missouri. Sergio Prieto. Go Gators.
Go Gators.
Go
And
Gators.
the Gators had a huge win in basketball last night. Beat Kentucky on the road. Go Gators.
Huge basketball win. Steven Chmielewski from Providence, Rhode Island.
Speaking of people who are putting pressure on for a second event, Steven took your advice, signed up for the waiting list, and promptly fired an email to my team saying, hey, I can't be here for this one, but I want to come to the one that's going to happen later in the year. So thank you, Steven.
The legendary Chmielewski full court press. I love it. Stanley Jocelyn in the house is back. Good to have you, Stanley. The patriarch and matriarch of the first family of the Not Your Average Best Show, Ken and Carolyn Meline.
We salute you.
The better Greg is also checked in.
Gregg Stone. By the way, Gregg Stone, the better Greg, just added new properties to his portfolio. So congratulations to the better Greg.
That's why they call him the better Greg. That's why they call him Greg. Good to see you pop up in that new property list, man. That's awesome. Reggie Fonse. Is it Fonse or Fonse?
I think whichever you decide, go strong with it because that's the way it is.
The stronger I go when I'm wrong, the quicker I get a reaction.
Sure. All right,
I remember when I used to call Hervé Francois, I'd be like, Francois.
Yeah, right.
Yeah. It's like, not Hervé, bro.
Yeah, man.
So, Reggie, good to have you in the house as well. Out of the IE, do you know what the IE is?
No.
Inland Empire, California, man. That is where I first moved out there when I, got my job, started in Miami. They moved me to managing a branch out of Corona and then in Riverside. And then I moved to Orange County.
What do you know?
Yeah, it's a beautiful little, it's close to the high desert. It's nice out there, man. We got the fairy godmother in the house.
Miss Jen Filson.
Miss Jen Filson. Greetings from Monterey, California, a beautiful part of the world. Marty Quinn from Golden, Colorado is back.
All right, Marty.
Good to have you, Marty. And Agnes Chioma.
Ooh.
Texas.
New name.
Well,
Agnes, thank you for being here.
welcome to the show, Agnes. I hope you make a habit out of it. We got Margaret Smith in the house. I like that.
Oh, and she asked all the questions. What was her name?
Margaret Smith is the Jeopardy queen.
The Jeopardy Queen. Thank you so much.
The queen of the questions. Good to have you. All right, GC. So as we start thinking about this, we got some breaking news. What's the breaking news,
We
GC?
do have some breaking news. It's that time of the month where we get to distribute rental income, net rental income to our clients. And it is the most fun day of the month for our team. And when we do get to send out the funds that our clients have earned, we send a team email out. We celebrate it because we should be celebrating wins like this. So I wanted to share that celebration with all of you. This month, we delivered net rental income to 1,809 clients to the tune of $5,330,577.04. So think about those funds going to you and your families and all of the good that you can do in this world. And we are so excited to be a part of it. So certainly something to celebrate.
Okay. Paid out $5,330,577.04
Don't forget the 4 cents.
to residents today.
To clients.
To clients. Oh, yeah.
Yeah, it was sent out
to
towards the end of the
investors.
month.
To investors.
Right.
You just distributed, just walked around like Santa Claus, jumping in and out of chimneys with stacks of checks, $5 million bucks.
There's more efficient ways to deliver the money than that, but that would be fun too.
That number just keeps getting growing, and it
does.
blows my mind.
It
Just
does.
I think the logistical distribution of $5 million bucks,
Yeah.
to me, is a business all unto itself, and it's just something that you guys do every single month. And that's not how much money you're making. That's not how much you're collecting. That is how much you are giving out to investors per month in their bank account cash.
Yes. And just to define it, that's the rental income that the investors have earned who are JWB clients. We're obviously the property management company as a part of our vertically integrated service. And so that is the net amount. There's the gross rental income that's collected, that we collect on behalf of our clients. We hold back the property management fees, and the difference is those $5 million. So there
Pretty
you go.
cool, man.
Get
Pretty
to,
cool.
It's fun to do that on a monthly basis.
Pretty cool to see that go.
And it's all about impact.
Yeah. All about impact. Love that, man. I also miss my boy Luis Olivares from the 305.
True.
In the chat. I skipped over him. Donna Chica checking in from Bakersfield. Good to have you back as well. So we also have something else here.
We do.
We've got a question that's being answered from a past show by Gregg. I feel like I got to come up with a better segment for that.
There we go. Work on that one a little bit.
Yeah, the patron Santorios, always infamous for his questions.
Clearly.
Infamous in a good way. Like more than famous.
Yes. The good type of infamous.
So he sent in a question that said, "Thank you for addressing my question during the show today. I as actually asking if JWB would engage in tenant outreach similar to what was done in April 2020 if the unemployment rate were to increase, mirroring the situation in 2020. If my memory serves me right, JWB proactively contacted each tenant to assess the impact of COVID, offering assistance or proposing a payment plan instead of resorting to eviction. I recall that the current rent rates were impressively high at that time, around 90%. And I'm curious to know if JWB considers this approach a viable tool for future use, and if so, what insights were gained from the previous experience. Thanks once again. Excited about the summit. And Ann and I are looking forward to it. We're looking forward to having you, buddy.
Absolutely. And thanks so much for sending the question. And he was a question that he asked live that I actually screwed up because I thought I answered something different. And so we appreciate everybody who has questions live, and you can always send them in to info@JWB companies, just like Michael. So Michael, to answer your question, a couple of things here. What we did during COVID, there were certain things that are just standard operating procedure as far as how we are here to take care of your investment, which would mean, of course, collecting rent and working with residents if there is a payment problem. There are certain standard things that we do, and then there's things that we did above and beyond because of the unprecedented nature that COVID was. But what you mentioned there, offering assistance and proposing payment plans instead of resorting to eviction, the good thing for everybody to know here is that's standard. That's standard. That's how we operate at JWB all the time. That is not standard for standard property management companies, for typical property management companies. Totally. But for us, we do a tremendous amount of work. Even if there is a payment issue with your residents, we want to work with that resident to make sure that that resident is served and that you're served as well. So those things would continue to happen regardless of whatever happens with unemployment. Unemployment is not something that we're expecting to spike to a large degree. So we're not anticipating that. Now, the extraordinary measures that we put in during COVID, going above and beyond as we did, we're not anticipating that those are going to be necessary right now. And so I wouldn't anticipate some of the additional things that we did beyond that. Like, first of all, understanding how the community services would work as far as rental assistance. It was a brand new world. And there were organizations out there that were coming up with ways to help residents, but the information was hard to figure out. So we put a task force on that and we figured that out, and we were able to help a lot of residents continue to stay in their homes, things like that. That's probably not going to be necessary right now, even if unemployment spikes. So we're not anticipating going to those same lengths because we don't anticipate unemployment becoming that big of a problem. But just know this, at the end of the day, our mission is to protect your investment and to make sure that we're serving the resident at the same time. So that's our mission. We will always do whatever it takes to do that. We would be monitoring vacancy rates. We would be monitoring other things that we do every single month. So long story short, if it needed to be done, we would do it, but I'm not anticipating those extra measures that were done during COVID.
What I hear in that answer, Gregg, is as JWB, you understand that what you do, what you provide to investors is essentially the peace of mind that you can enter a very complicated asset class without having to worry about it.
Yes.
Right? And you have very strategically built your business around this flywheel that affects that experience, right? It is not just, hey, can I acquire houses at a good price. It's not, hey, can I remodel homes that I find off market to a certain standard in a way that there is like an extra amount of profit when I turn this deal over to an investor?
Mhm.
It's not just, can I also market this thing and get it filled in one time or even many times and have a line of tenants out the door wanting to live in these assets? It is understanding that for this thing to work, occupancy is key,
Mhm.
right? Like lowering vacancy rates is key. And having a team that is agile enough to coalesce around the problem,
Mhm.
right? The problem being vacancy.
Mhm.
So when something that is way out of the norm
Mhm.
happens, which was COVID,
Mhm.
way out of the norm,
Mhm.
right? Like
Yeah.
we can say that a week before March 14th, we had no clue that this could possibly be possible.
Yeah, that's true.
Right? Until they shut down the NBA. We
That
did
is true.
not believe that that was going to happen. And at a moment's notice, you were able to act quick with your team outside of what you normally do, outside of the normal scope of work of what they've been trained to just pounce on like one thing that is at the end of the day, the problem that you solve, keeping the asset performing and letting people sleep at night.
Mhm.
And that was, for all of us watching, a giant show of force that maybe, the show was new. So maybe we didn't really understand the business that well. But what I'm also hearing you say is that if that is ever required, you're able to ramp that up again because you have a team that
Yeah.
that has proven to be able to do that. Just that the things that we are looking at in the economy coming forth, right? Going from 3% unemployment rate to 5% unemployment rate are not going to be something that is going to affect us as investors in the same manner that COVID complete disruption potentially could. So it's just a matter of you have levers that you can pull. You have a machine that runs every single day, and that machine can handle all these different things. But if you ever need to like take that machine off of a different exit and down to like a dirt path, you're able to do.
You've seen it, and those who were here on the show 4 years ago saw it in real time as well. So we do have that ability to do that. And yeah, I think it's a great question. But, the things that we're probably going to see in the economy this year are things that we've seen over and over and over again. And unemployment right now is really low anyways. So certainly not on my radar as far as being a concern that would require, additional measures like that.
Cool. Speaking of a concern, so Leo Faraganan has something here in the Q&A. Maybe we can knock this out before we get into the meat of the content today. He's saying, my second JWB property, 2 years in, I'm assuming,
Mhm.
the property tax was adjusted around $6K more now in my mortgage escrow, additional around $500 in monthly in mortgage.
Mhm.
It's going to be a negative cash flow at this point. I had reached out to Michelle Ryan, JWBCR coordinator, and I will be assessing this soon with my portfolio manager. Definitely holding on, but what else do you recommend at this point? Sorry that we will miss this summit as we have some nasty IT audit during that week.
Oh, nobody
We're
wants a
so-
nasty IT audit.
Nobody wants a nasty IT audit for like NASA, right? Isn't that what like Leo's working on out there?
Yeah.
Yeah. Leo, we're gonna miss you, man.
We are going to
But
miss
yeah,
you.
any advice for Leo on?
Yes, absolutely. So let me just explain what's happening here. Leo bought his second property with JWB. We laid out the plan with Leo to build that property in conjunction with accomplishing his financial goals. Each property has a pro forma where it lays out, here's what your expected positive cash flow is. We go through the closing, we set the property up, we set the loan up, we do all of those things. And then there are some things that are outside of JWB's control. One of the things that is outside of JWB's control is how the escrow, the mortgage escrow, is handled between Leo and his lender. And we supply all the information as far as what property taxes will be and insurance will be. But sometimes lenders do their own thing. And so sometimes what lenders do is they don't use the information that is provided for them, and they either over escrow mortgage amounts, meaning like taxes might be $3,000 for the year and they hold back $6,000 for the year for taxes, even though that is not real. Or sometimes they under escrow and the taxes, property taxes might be $3,000 for the year and they only hold back $1,000. And that is the lender thing. As you can imagine, sometimes with banks, the left hand doesn't know what the right hand is doing. And so this can be a real thing for clients because ultimately this does affect your cash flow. Your asset is working just like described, But because of that bank over escrow or under escrow, you can feel a cash flow pinch, or you can feel a surplus of cash flow.
Mhm.
So it's not uncommon. I think we had a similar question to this last show or the show before as well. So I'm glad that we're bringing more and more light to it.
Yeah, I'm going through this with Katina as well.
You are as well?
Yeah.
Okay. So what happens is there's a balancing effect. It usually takes a year for there to be a balancing effect. And let's just say that they under escrow typically is what will happen first.
Mhm.
They'll under escrow.
Mhm.
So for that year, maybe in Katina, maybe for Leo, the previous year, you probably had an overabundance of cash flow, even more than we told you to expect on the evaluation, because they under escrowed. Then what they do is realize, oh goodness, we didn't have enough money in escrow to make the property tax payment.
Mhm.
And so the following year is what they do is they make up for it by over escrowing you.
Mhm.
And usually they get their act together, and it might take a couple of years for this to get back to what taxes really should be. But for that couple of years, you're either going to have more cash flow or you're going to have less cash flow, even though the asset is performing. So, that's really where it is, Leo. As far as advice on what to do, hopefully you're saving that cash flow, that excess of cash flow that you received when it was under escrowed. You save that because that should more than offset the situation you're in now. If you haven't, there's not much that you can do right now because they just collected too little taxes or insurance for you.
Mhm.
You just got to kind of wait it out. But just know that it will come back and should level out. You got to give it a little bit of time.
Let me ask you a couple of those clarifying questions there. All right. So basically, the mortgage company they took out too little in order to pay for the taxes.
Mm-hmm.
And then once they realize, oh crap, I messed up here. Now they're taking out not just like enough of what they needed to the year prior or the 2 years prior,
Mm-hmm.
but that plus the thing to make up for the years before.
Bingo.
And what I'm hearing from you then is that means that at some point it's going to go back down to the real number that they should, right? So if the pendulum is over here, it's going to swing to over here. But then in what it sounds like about a year or two, maybe it'll swing back to the middle. And then your cash flow will for sure be positive again. And then just continue to increase as rents go up.
Yeah, I mean, there's a lot of things that go into positive cash flow.
Mhm.
The mortgage payment, the taxes, insurance are one component of
Yeah.
that. So it is possible for you to be positive cash flow even if they over escrow.
Yeah.
Because you could have gotten more rental income. We could have had a rent increase.
Mhm.
You could have had no maintenance cost or things like that.
Yeah.
So it's difficult to say you are definitely going to be positive cash flow or that you're definitely negative cash flow if they over escrow. But what will happen over time is they'll get their act together and they'll escrow, and your mortgage payment will be the right amount.
Got it.
And it'll set you up for positive cash flow because that's the way that this investment was set up in the beginning.
Yeah. And in the meantime, the property is doing what it was going to do anyway.
Exactly.
Right? It is still producing all those profit centers. It's just you're either prepaying for some of that right now and you didn't before.
And if you want to double check this, you can go onto the tax assessor's website in Duval County, and you can look up your tax bill to see really what your property taxes are. And, you can look on your mortgage payment and see how much they're escrowing.
Mhm.
And if they should be escrowing $250 a month for that, based on what the tax bill is, but they're escrowing $500, well, you're going to see that over escrow amount, and you'll be able to, see the proof there.
Yeah. And what I've learned in my experience, Greg, is that everything that you've told me has come true in the sense that my property at Katina is now slightly monthly cash flow negative, but I have 3 properties.
Mm-hmm.
And my other 2 properties are overperforming right now.
There you go.
So my portfolio is still very cash flow positive, even though one property right now, until this thing gets fixed, is cash flow negative.
And it's cash flow negative because of the over
escrow.
Yeah.
Correct.
There you go. That's why 3 properties wins.
Yeah. So got a question here in the chat from Agnes Choma. Agnes, probably first time here, but she's asking, do you have an in-house property management company that handles the management of the properties invested with you? What do you say to that, GC?
First of all, Agnes, thank you so much for being here. Thank you for having the courage to ask a question. And you lobbed up a softball for me.
It's a softball.
Yes, absolutely. Very strong. Yes, we are the property management company. And part of the reason that you may want to invest with JWB is because we're a vertically integrated company, which means that we have all aspects under one roof. And that is incredibly important when you're making a decision to invest in rental properties.
That's right. So Agnes, when we say vertically integrated, the reason why it's so important is this idea of, I don't know if you've ever had work done at your house, right? But you might have a general contractor and the general contractor hires a drywall guy, and then the general contractor hires a paint guy. And all of a sudden, a month later, your wall doesn't look quite right. Right. And then you go back to the general contractor and you're like, what's going on here? And the general contractor's like, well, it was the drywall guy's fault. And then you go to the drywall guy and the guy's like, no. The paint was done wrong here. This is why it doesn't look right. And the painter comes in and goes, no. The general contractor told me that this was only going to be $1,000. And so I estimated. Anyways, it's a big blame game when we're dealing with a realtor, a builder, and a property manager. When we say vertical integration, it means that the general contractor is the guy that put up the drywall, the guy that painted it, and the guy that planned for all of it. So if you have an issue with the wall, there's one person to go to, and you can't hide behind any excuses. So the JWB business model is built that way. If the property is not performing, nobody's going to shift the blame here. They've actually built one of the biggest single-family home property management companies in the United States underneath this whole investment vehicle company that they have. And they're not just acquiring land, they're not just remodeling land, they're managing over 6,000 properties, and also managing your portfolio while doing it. They have in-house asset managers that tell you where the money's going and what to do with it and things of the sort, as well as revitalizing downtown Jacksonville, which is driving up median income rates. So yeah, they do have a property management company here.
Well said. Well said. And thank you so much for that question, Agnes.
Yeah, great question. All right, here we go. So now let's take them to class, GC.
Okay.
We are talking about this amazing spike in rental property, in rental income amazing spike in rent prices.
Yes.
That has happened in the US since COVID.
Yes.
Why is that happening?
Oh, wow. Well, there's a lot that has gone into that. It first starts with an undersupply of housing. And we talk about this a lot because an undersupply of housing is what keeps a high floor for home prices. And it also keeps a high floor for rents. And it goes a little bit farther than that when you think about what's actually happened with home prices and rents as well. You have that high floor, but when you start to sprinkle in the amount of money that was injected into the economy over the past 3 years, 4 years now, you start to understand why prices, not just rent prices, not just home prices, but prices on everything across the board started to raise incredibly high at rates that we haven't seen in 40 years. So it's a combination of those two things. It is low supply of housing, and then you filled the bank accounts of Americans by a lot of either stimulus or Fed activity to pump more money into the economy. And that's a combination for prices on many products and services to go up, rents being one of them.
Yeah. So one of those things is same reason why there's inflation.
Yes.
Right. And the other is a chronic issue that we see as kind of like the information advantage for rental home investors. It's that the untold story here is that there's an undersupply of single family homes in large cities, and specifically an undersupply of workforce housing in growing, thriving cities that, when you look at supply and demand, the laws of economics say that if there is not enough supply for the demand there, prices go up.
Exactly.
Right? So we're going to dive into exactly how much they've gone up and what it all means and how much longer it's going to happen. And just as importantly, is this hurting that workforce resident that needs this asset class to live? So before we get into that, GC, you always like to tell everybody a little bit something.
I do, especially when we have new folks like Agnes joining and whatnot. It's always good for you all to do your own due diligence. I'm going to share some numbers with you to help you to illustrate some points here. These are estimates only. They are not guaranteed. This is not financial advice. You should do your own due diligence. We're not financial advisors. And with that, let's jump into it.
All right, GC. So how high have these prices gone?
Well, I'm glad you asked. Okay, I think I want to just put like a baseline out there of what does a typical rent increase look like in Jacksonville. And we have the benefit of a lot of years to gain perspective here. So I went back from 1985 to 2022. And if you go back those 38 years there, rents increased on average 3.7% per year in Jacksonville, Florida. Some other noteworthy things here. You can start to see, you can take that data and say, okay, what's more likely here? Did they go up 10% some years and did they drop some years?
Yeah.
Let's get a little bit more insight. So the largest ever annual rent increase on average was 11.9%.
Okay.
And that was in the year 2021.
Makes sense.
What was going on in the economy in 2021?
We had just gotten off the back of COVID, and there was a bunch of cash flow pumped into the economy with the stimuluses. Inflation was raging.
Exactly.
So prices were going up on just about everything, and we were still very low on housing.
So we're connecting the dots on that question that you just asked me about why did rents go up? Well, you can see a combination of stimulus and Fed actions along with low housing supply led to that in 2021. There have only been 2 years where it's been over 10%.
Okay.
In 38 years. You want to guess what those 2 years were?
21 and 20?
2021 and 2022.
Okay.
So it's very not normal for it to be that high.
So outlier, right?
Outliers.
Like those 2 years were outliers of being over 10% rent increase.
Yes.
Right.
But what's not an outlier is that rents go up. So rents actually increased 97% of the years. 37 out of 38 years, rents in Jacksonville have gone up. So when we talk about why this is such a consistent asset class, something you can depend on and rely on, whereas there's other asset classes that you really can't, rents going up in Jacksonville happen 97% of the time.
So 37 out of the 38 years, rent has gone up.
Yes.
Okay, continue.
Now, I wanted to see, okay, what's a likely rent increase? So rents increased at least 2% per year on average, 84% of the time. So 32 out of 38 years, rents went up at least 2% or more.
Okay.
So if you're a betting man or woman, you can pretty much bank on that.
You can bank on at least 2% rent increase each and every year.
The data tells us it happens over 8 out of 10 times.
Pretty standard. Okay.
There was only 1 year that rents decreased. There was 1 year that rents decreased. And they only decreased 0.5%. So, and that was in 2010. What happened in 2010?
Great Recession.
It was the Great Recession, right? The Great Recession actually really in real estate lasted from 2007 to 2011.
Yep.
So at the
Great Recession,
it dropped 0.5% here in Jacksonville.
Yeah.
Actually, over time from 2007 to 2011, in the depths of the Great Recession, rents actually went up in Jacksonville, if you look over that time period. So you can kind of see what the downside risk of decreases of rents are, and it is incredibly rare for rents to go down in Jacksonville. In fact, across the entire country, rents have never decreased on record for the entire country.
Got it. So if what we are talking about here is how long is this party going to last of rents going up? And that's the question. It sounds like the party's here to stay. Right? Like, or it's likely that that party happens every single year. And the party, while it's not going to be a rager every single year like it was in 2021 and 2022, where rents went up 10% plus, it seems like a nice little get together every single year of good friends, a nice little barbecue.
Normalization
of what looks like 3.7% per year on average is a very reasonable thing to expect. And it's very unlikely that it's going to be less than a 2% increase because that generally happens. And it's going to be really, really shockingly unlikely that nobody shows up to the party.
Exactly. And if you guys, were wondering a year ago why I said, listen, I think rents are going to go up in 2023. We were one of the only, I don't know what you call us, media outlets to actually say that and put our name on it. Well, the reason is because I know how unlikely it is for rents to go down. And I also know what low supply we have for housing. So helps you to get kind of inside our heads a little bit. And then of course, rents have gone up in 2023 in Jacksonville. We're still waiting on the final numbers, but somewhere around 2 to 3% is where it's going to be for rent growth in 2023 on the heels of unprecedented rent growth in 2021 and 2022.
Got it. So rents are going to continue to go up in the short term.
Yeah, that's what we're expecting.
Okay. What else?
So then let's talk about, now that we have the perspective, how unique is it and how much have rents gone
Ronald
up?
Thring is asking, are you talking about single family residences or all rents, at least like rents from apartments and everything?
Great question. I'm specifically talking about single family rental properties.
Okay, cool.
So now let's put this in perspective of what happened over the last 3 years and really what happened over the last 10 years and compare it to what's normal. Well, from 2020 to 2022, so those 3 years, rents increased on average 27%. That's 9% rent increases per year on average. Very unlikely. That's 2.5 times the normal rent increase average. So this is an unprecedented time that we've seen in the last 3 years.
Okay.
And then I peeled back a little bit more. What's happened over the last 10 years in Jacksonville? And average rents have increased 51% over the 10 years. So, of course, that comes out to about a 5% rent increase on average per year.
Got it. So the last 3 years, it's gone up a total of 27%, which is an average of 9% per year over the last 3 years, super high. Over the last 10 years, it's gone up 51%. So if I bought something that the rent was $100 a month 10 years ago, today it's $150 a month, right? So, and the average rent increase has been 5%, so higher than that like 30-year average so far. So we've been at an elevated period of increased rents in Jacksonville.
Exactly.
Okay. What else?
Well, then I said, okay, let's look at this from all perspectives here. And the first perspective that I want to look at this is through the investor lens. Okay, if you are an investor who bought a rental property with JWB in 2020, what does life look like right now, knowing that rents have gone up like this? Okay. So that's what I did. I pulled a property a real property that was purchased by a client in 2020. It's here on Lucent Drive on the west side of Jacksonville, one of our 4 core neighborhoods. And we'll look at the numbers here of what did we say was going to happen. And then as we saw this outsized rent growth, how is that affecting this client's cash flow? Okay, let's look at it. And here we go. So if we go the year 2020, when this client purchased the home, the rent was $1,075 per month. That's the gross monthly rent. You take out all of the expenses that come along with it, like maintenance costs, vacancy costs, your mortgage payment, property management costs, all of those associated costs. You take all that out. And this client purchased this property expecting about $85 a month in cash flow, right? Now, hopefully, when you look at that number, you look at that and you say, hey, well, that's awesome. $85 a month. There's not many assets that put some positive cash flow in my pockets every single month. But what many of you, especially as newer folks, might be saying, well, that's not a lot. You know, that's not a lot. And you're right. Cash flow year one is not going to change your life. It's not the reason to get into this investment. If you're curious about more than that, you can go to any of our videos on YouTube when we talk about the 5 profit centers. You know, net rental income, when you buy the property, make sure it's cash flow positive. But the beauty is what happens years down the road as the cash flow grows for when you really, truly need it. And guess what? We had a spike in rents. Rent prices spiked more than they ever have in a 3-year period of time. I didn't know that was going to happen. But this client certainly has benefited from that, just like you've benefited from that. Absolutely. Because you bought your first property in it was 2020, actually.
Early 2021, no?
Looked yesterday. Okay. 2020.
You know better than I do.
Minosa?
Yeah.
I think that was in 2020.
Yeah,
regardless,
makes sense.
Splitting hairs, right? 2020, 2021, 2022 for you. And all of you who have bought properties in 2020. So this client's property now rents for $1,461 a month. You take away all the costs that have come along with that as well, and he's left with net rental income of $215 a month right here, right now, for an average difference of $130 a month of net rental income, which when you put that out to a year, that's $1,500, $1,800 a year of additional net rental income, which he wasn't assuming would be here day one when he bought that property.
Yeah. I look at that and I think, all right, maybe I'm thinking that this cash flow is going to pay for my cell phone bill month after month, or maybe YouTube TV or something like that. But it turns out it's paying for my car insurance. Right? Sure. So like that's a nice little bump.
There you go. It's nothing that's going to change your life, but the important thing is get this asset and it grows and it grows and it grows and it grows. And then it does change your life at some point here soon. Something else to consider here, you know, I often hear on the show great questions from clients, and they might say, well, hey, listen, my property taxes went up. Right? What should I do about this? Right? Or my insurance costs have gone up. What should I do about this? And what I'm very quick to point out is, yes, that has happened. It's happened on your properties. It's happened on your properties, I'm sure. But we need to take into perspective what all is happening to see if we're winning. And so this client example here is very representative for all of you too. Because in this example, his taxes went up from $1,620 when he bought in 2020 to $2,741 in 2023. Yes.
So it went up for the year. It went up about $1,100.
Yes.
Okay, got it.
Right. So that's an additional cost that's taken into account there.
Mm-hmm.
Property insurance increased from $623 to about $1,500.
Mm-hmm.
So, those additional costs are there, but we're not fully understanding how much rents have gone up.
Mm-hmm.
And when you take into the account the additional costs from taxes, insurance, and other costs along the way,
Mm-hmm.
many times it's more than offset by the rental increases that you've seen. And I want everybody to see that, because when that happens, that's how you get to that net difference of, call it $1,500 or $1,800 a year of additional net rental income, taking those things into account.
That makes sense. So you have costs that might go up and you feel that, but you're also having your cash flow, your revenue go up that can offset those costs. And then on top of that, as we know here on the Not Your Average Investor Show, the majority of wealth we're going to build over time is the appreciation of the home. And that's been going up extraordinarily.
Oh, yeah.
Which dwarfs everything else, right?
Yeah. $81,000 of home price appreciation for this client on Lucent.
Yeah.
So you're winning on a net rental income basis. You're really winning on wealth accumulation when you get to the other profit centers.
Makes sense. And then that's the last 3 years, right? But then there's also the idea that, hey, we're in here, we're long-term investors here, right? So it might have only gone up, it might have gone up $180 per month in the first 3 years, but by year 10, this property is going to be at $530 per month in more rent.
Mm-hmm.
And then in year 20, it's going to have $1,000 per month in more rent.
Mm-hmm.
In year 30, it's going to have another $700 on top of that. So $1,700 more per month. So this again is an asset that's and this is based on what assumptions you see? Is this like that 3% going up or?
Yes, this is based on 3.7% going up year over year over year for rents, like we talked about.
Yep.
But what it also includes is expecting property taxes and insurance costs and other costs as well to be going up. So this is the net rental income 10 years from now of what this client should expect from this home, or 20 years or 30 years. And when you start to see $1,700 in net rental income coming for just one asset, that's where it starts to get life-changing,
Super
right? Or you stack this with properties, a portfolio is like 3 properties in a portfolio, or 5 or 20, like some of our clients have.
Yeah.
And now you're seeing the life-changing effects of owning rental properties.
Plus your net worth having gone up astronomically, because now we're talking about that home price appreciation. That's really just like a number that, again, completely dwarfs all this stuff.
Exactly.
And everything that comes with, right? So that's rent growth over time. In the short run, we're looking at this, GC, can you explain this?
Yeah, so a common question is, well, rents, can they continue to go up? There's been this huge spike in rents. What are the experts expecting? And this is from John Burns Real Estate Consulting. And John and his team put together projections for what they expect each market rent to go up, as well as the US overall. And the experts are expecting rents to continue to rise, especially in Jacksonville. And so I put here in 2024, they're expecting 4% rent growth. Same thing in 2025 and 2026, they're actually expecting 4.8% rent growth here in Jacksonville. And that's more than what the US is expected for rent growth as well. But it's noticeable here, the US is expected to go up in rent as well. So get used to rents going up. It's happened 97% of the years in the past for Jacksonville. It's a normal part of the process.
So rents going up is a normal part of the process. It's the idea that the US economy is growing. There's going to be inflation happening, period, right? What I'm seeing beyond these numbers here, GC, are 2 things. One is we talk a lot about the show about how Jacksonville is special and how it is a city that is still underpriced and it's going to grow at a faster rate than other cities around it, and particularly with downtown coming back on. And it looks like, if I look at our expected rent growth and the U.S. expected rent growth, that John Burns agrees.
Well, yeah, but John's not even really clued into what's going on in downtown Jacksonville. These reports are based on not that insider knowledge that we're all going to have a fun time talking about at the summit and we talk about here. So I would look at that as significant upside over what we see here.
Okay. And then the other thing that I'm seeing here is it feels like, if I look at the idea that over the last 30 years, it's been 3% rent growth. And over the last 10 years, it's been 5% rent growth. And Burns is expecting over the next 3 years to be at 4% and 4.8% after this like period of like crazy 10% plus. It feels like we're almost at a new normal, right? Like I know that you guys like to be very conservative in your data. And in those projections that you just shared, you're saying 3.6%. But there's definitely a possibility here that rent growth in Jacksonville over the next 30 years is going to be higher than the last 30 years on average.
Yeah, certainly possible. We build these expectations knowing that we want to underpromise and overdeliver. So a lot of opportunities to deliver better returns, more rent growth is certainly one of them.
Okay. All right. So this is the party for investors,
Yeah.
right? Investors love seeing these numbers because what it means is everything that we talk about. This is an asset that you invest in that gets better over time, like a fine wine.
Yep.
Right. And even in your late stages of your life, when you really need this cash flow and you're actually living off of it, that still continues to improve as opposed to maybe other asset classes where you just kind of build up to a certain amount and then you get a withdraw from it and become very, very conservative and it might go up and down.
Right.
That's what we're in it for.
Yep.
Now, if we were to think beyond that, beyond our own personal gain, and we were asked the question, what about the residents?
Yeah.
Is this bad for the city? Is this bad for the workforce housing stock? Am I benefiting off of other people's pain?
Right. I love that we have space to talk about this from a different perspective as well, because I don't think investors talk about the resident perspective enough. And there's no reason that there have to be two different perspectives. There's a way to recognize and appreciate how everybody can win in the long run here. And so I wanted to take a step back and just think about it from the space of our community and our residents. And because at the end of the day, if we're not serving our residents, there's no way that we can perform in this asset class. And so we do it for that reason, but we do it for more than that because that's the type of people that we are. And we want to serve and raise whoever we can. And so, you know, when you start to think about what's actually happening bigger picture here, there's a flywheel that I wanted to share with all of you. And higher rents are a part of that flywheel where everybody can win. So let's start with that flywheel, right? It usually starts somewhere with either more and better jobs or population growth. It kind of starts there, right? Yeah. We've seen population growth in Jacksonville, right? We've seen more and better jobs. When you have more better jobs and population growth, that leads to higher median incomes. Higher median incomes are critical here. This is one of the reasons, and we'll share more about this on the summit, but this is one of the reasons we're so passionate about building downtown and revitalizing downtown. Is because we believe when we raise median incomes, the rising tide lifts all boats and everybody wins, right? If the median incomes would rise, people can afford higher rents and it doesn't displace them, right? So raising median incomes is something that we're passionate about. So when you have median incomes that rise and you have higher rents that will follow.
Well, median incomes rise, people have more money, and they're gonna, you know, like there's gonna be a higher demand for higher price things.
Exactly.
Right. Just like the Fed pumping money into the economy raised rents, like
artificially,
really fast artificially.
Yes.
Higher median income means, man, I've got this money.
That's the sustainable way.
That's the sustainable
way. So, right. But the key is raising median incomes.
Yeah.
Right. And that's something that developers and, you know, that's what developers know, because when they raise median incomes, that leads to higher rents. Higher rents are what developers like JWB need to see in order for us to make bigger investments that will lead to the next part of the flywheel, which is more amenities, right? When you think about grocery stores going into neighborhoods, bars, restaurants, when you think about what higher rents contribute to, they contribute to higher property taxes as well. So we want our teachers, firefighters, police, of course, our infrastructure and our community. All of these things happen because higher median incomes lead to higher rents, more amenities. And what this does is it leads to a higher quality of life in the community. This cycle continues to happen. This is the cycle that we're interested in.
Yeah.
Right? Because everybody can win in this cycle. That then leads to more and better jobs because employers want to be here where there's a higher quality of life, leads to population growth, and you see how this happens. So that's the big picture of how the community can win. But let's take a moment here and just pause because this isn't real life right now for residents, right? We're at a point right now where it's difficult for residents. It's difficult for every resident, no matter which part of the country you are in. Some of you may call them tenants, right? Residents is what we call at JWB. But you've just had the largest increase in rents in a 3-year time period since we started tracking that. And this flywheel that I'm talking about takes time.
Yeah.
It takes time for these things to happen. And so I think looking and understanding that this is probably the most difficult time for residents to absorb that increase. Wages overall haven't kept up nationwide. They couldn't keep up to these types of rent increases, and just live there and understand that this is a tough moment for residents. But the message really is, you know, higher rents are a part of a very positive process for the entire community and for the entire region. And you can do it in a way where everybody wins. And that's what our intention is.
I want to get into the nuts and bolts on how you do it, because we got some questions about that, but I want to just kind of recap what you said, right? And I'll start from where you ended. This is probably the hardest, the most painful point in a long time for the workforce housing resident, because we've seen an outlier of increased rent that has happened recently, and we are sympathetic to that, right? Like, there is right now, it is a bit of a squeeze for many Americans across the country, and definitely in Jacksonville as well. But what you're trying to say is, if you zoom out, higher rents are really just a part of an ecosystem, right? An ecosystem that, when it's operating in the way that it should, becomes a bit of a flywheel.
Yes.
Which is essentially, higher rents are caused because population growth has driven up higher median incomes, which means that folks out there are demanding and asking for more things, right? Demand has increased for rents and better housing, which raises the rent. And once that rent is raised, and other developers see this thing and they say, oh, okay, well, if rent is at this price point, then I can come in here and build better things, more things. Whole Foods wants to come in and sell to those people. Schools, you know, like, will get better and things of the sort, because there's an increased tax basis. There's more investments being put into the society, which makes more amenities, which increases the higher quality of life. And once quality of life increases, then companies are looking around thinking, where do I want to bring my headquarters? Where do I want to recruit people to? Local companies are thinking, man, I should expand because things are good. I'm going to hire more people. I'm going to bring in a VP of this thing that before was just like done by an administrator, right? I'm going to create that opportunity local. So there's more better jobs. And as more jobs are out there, then more people want to live here because there's better jobs and higher quality of life, which means that, again, income increases, median incomes increase, higher rents increase, more amenities get built, quality of life goes even more up, more jobs show up. Population grows, higher median incomes, higher rents, right? It's a flywheel that continues to feed itself.
Exactly.
And when looked at it that way, then over the long term, it's good for society. Right? I want to get into just this window right now, which is Antonio del Monaco asks, great name, by the way, Antonio. Welcome to the show. That's a new name. I've never heard that before. My middle name is Antonio. Asking, how do you inform tenants that their renewal rent is going to be higher, and deal with the typical objection of them saying that they will move to another property around the corner that is being offered at the rent that they are paying now?
Yeah, you know, we really believe that through effective communication, through compassion, but setting the right expectations right off the bat, you can really help residents see how this is a great value to them to be able to rent with JWB, and to understand that rent increases are a part of the marketplace. This is not a solely JWB initiative. The data is out there that if it wasn't going to have a rent increase with JWB, it's going to be with that next person that they would be renting with. So, you know, by being articulate and understanding that and helping to educate and doing it with compassion, we feel like, you know, that's the recipe to really help people, you know, invest or to buy or lease a property or whatnot. That's kind of standard around JWB. So we equip our team with that information, that knowledge. We train, we make sure that we are treating people the right way. And, you know, at the end of the day, we rent out, you know, over 1,200 homes this year by doing that. And we sign on average 2 and 3 year leases by doing that. And, you know, a great thing to know too, is not only do we rent out homes, that number of homes for that length of time, but when the time comes up,
when you say rent out 1,200 homes, you mean you put in a new resident into a home 1,200 times a year, but you actually rent out 6,000 homes a year.
Yes, we manage 6,000 homes.
Yeah.
Not all of those come up for rent each year,
correct.
right? So 1,200 is the number of homes that we rented in 2023. So a great point there. And the next question you should be asking is, how do they like their experience? Do they want to keep buying from us? Do they want to keep renting from us? You only do that if you like your experience. Over 70% of residents choose to renew with JWB.
70% choose to renew.
And they have had to absorb large rent increases in order to do that. So it's all about providing value and communicating clearly.
GC, I think you answered that in a very human way, which is very typical of you, to Antonio's question. And I think it makes a lot of sense, right? Like you do it with compassion, you train people to do it, you rely on giving them a good experience, which is going to make them want to stay, and you have the data to prove it. Antonio, what I'll tell you as a guy that looks really admirationally at what this company has been able to do, the way that I would say it is JWB, unlike most property management companies, JWB has wrapped their business around a problem instead of a product, or instead of a brand, or instead of a feature, or whatever. They have wrapped their business around this idea that in order to be able to get this asset to perform for you, they need to be able to keep it rented. So everything that they have done is aimed at that one joint, right? That joint of like putting a resident in place and making sure that they stay. And what that means is they do a couple of different things. Number one, they sign minimum 2-year leases, and they really sign 2- and 3-year leases. So the average lease that you sign is
26 months.
26 months, right? Is the average lease that is signed at JWB. That in itself allows you to understand that a resident is going to stay longer. But just as importantly, and this is something that most property management companies can't do because they don't have the scale, but if you go to most property management companies, what they do is they'll grow as their portfolio of properties grow, and they'll hire a person every, like once you get to like 10 homes, now you got to go hire another property manager. So this one property manager can manage 5, and the other one can manage 5. And as it continues to grow, they grow to 10, and then they go hire another one, and they do that. JWB has gone beyond that scale now with the 6,000 homes. And what they have is a department that manages metrics, not per property, right? So each department, there's a department that handles getting new residents in.
Leasing, property management, maintenance.
There's a department that handles maintenance, and there's a department that handles renewals.
Right.
So this question that you're asking of how do you communicate your rent's going to go up, and oh, by the way, I want you to stay here and I want you to sign another 2-3-year lease, is they train their team as this is a sales opportunity for them. They are trained as account executives in their portfolio of residents, and they're out there 6 months before building a relationship throughout it the whole time, so that 4 months before they already know them, and they have this conversation like, hey, as you know, your 2-3-year lease is about to come up. This is what the market is doing. So if you go anywhere else, you're probably looking to go up this much in rent, no matter what.
Mm-hmm.
That's gonna hurt you because you also have to pay for moving expenses, blah, 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 blah. And for 4 months, they're talking to them, making it obvious that it's in their best interest to, hey, let's just accept this 3% rent increase because at the end of the day, it's best for me. And oh, by the way, if you go live in another single family home that's operated by another landlord, they're probably not at the scale of JWB here in Jacksonville. And that means that if a toilet breaks, you're like waiting for Pablo to call his plumber and say, I need you here. When can you get here? Blah, 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 blah. Whereas at JWB, they have like a whole army of people that are doing this day in and day out. Right. So at the end of the day, when he's saying provide value, it's just giving them a better option anyways. And on top of that, they've built a certain scale and a certain team that manages this thing the way that an account executive manages you renewing your Salesforce, like software subscription, more so than just like, oh, hey, 5% more. Are you staying or are you not?
Yeah. 100%.
Cool. I had to go off on that because
well done, man.
I think it's really cool. All right, GC. So let's I got a couple more questions. Let's just finish kind of like what we're talking here.
Yep.
So there's this flywheel in this ecosystem that you are a part of, right? you're working on the higher median income thing. You're building a better downtown. But talk to me about how this flywheel right now, snapshot of it in Jacksonville looks.
Absolutely. So what else is increasing in Jacksonville? I don't know. Are they seeing on the screen right now?
No, not yet. You want to show it?
Yeah, these are good numbers to see, because I think it's really cool for us to see what else is working in Jacksonville to help us see that flywheel and what stages are there. Is this thing working, right? Because there are definitely other places in the country where rents have gone up, but the flywheel's not working, or it's definitely not working as well. So here's what's going on in Jacksonville. You compare where we were in 2017 to where we are in 2023. Our population has increased. It's a great sign. People want to be here, right? We've gone up from 1.51 million people in the MSA to 1.68 million people. What else is going up? Our median household income, right? That critical measure where everybody can win. Well, guess what? It's going up. It's going up substantially. We had a median household income in 2017 in Jacksonville of $58,700. Now it's $74,900. I think that's 27%. I was doing the math late at night. Somebody can check me on that. But 27% median income growth, household median income growth in Jacksonville over that time period. Jobs have gone up, right? So you were talking about how new jobs, better jobs, find that talent. They want to be in that place where people know there's a higher quality of life. Well, guess what? We've added over 125,000 jobs from 2017 to 2023.
Pretty good.
Right. And then unemployment as well. Unemployment has gone down significantly. We have one of the lowest unemployment rates in the country right now. It was 4.8% in 2017. It's 2.5% now as of this data from the US Census and Bureau of Labor Statistics. So all four of these critical leading indicators are showing you that this cycle is working in Jacksonville. It's hard for residents right now because it is the major point of pain because the rents have gone up and they haven't seen the amenities in full force yet. But this is what we are investing in. You are investing. When you make a JWB investment, you're investing in this. And this is that win that everybody can have, the resident and of course you in the long run as well.
Yeah. So if we're looking at this, right, we didn't show this graphic before, but if we're looking at this thing of like population growth drives up higher incomes, drives up rents, drives up amenities, drives up quality of life, brings better jobs, these numbers right here, right? Population growth of 100,000, almost 200,000 people have moved here in the last 5 years, has driven up the median income by $16,000 in the last 5 years, has increased the amount of jobs inside of Jacksonville by 130,000, 125,000 here in the last 5 years, and has dropped the unemployment rate in the last 5 years by half.
Boom.
From 4.8 to 2.5%. So this is the flywheel at work that's happening, which tells you the answer to the question, is this going to be sustainable for Jacksonville? That's a yes.
That's a yes.
Because that means the flywheel is working.
And the dollars who are going to be making the decisions to develop the amenities are looking at this.
Correct.
They look at this and they say, boom, that's where I want to be.
I'm going to keep spending money there to keep making it better because I want to accelerate this thing because I want my rents.
I'm going to put in a grocery store. I'm going to take the risk to build a shopping center. I'm going to put in bars, restaurants. Yep. All of this good stuff. These are leading indicators.
Yeah. And here's the big king stat right here. You want to talk about it?
Well, I came across this stat as I was doing my research late last night. It's a stat that I haven't shared because I honestly didn't know it before last night, but it is such a great stat for us to all know and love, right? So Jacksonville has the highest growth rate of corporate relocations of any major U.S. city from 2022 to 2023. Jacksonville, the #1 major U.S. city in the country for corporate relocations. It's in the state, which is the #1 state, which is a lot of people do think of Florida as a great state for corporate relocations. But it's not that just Florida's #1. Florida's #1 by a large margin. It has more than 15% higher corporate relocations, the growth rate for corporate relocations higher than the second one. So you're in the prime state for corporate relocations. And you're in the prime city. And why is that? Because people love living in Jacksonville. Yeah. And if the talent's here, employers want to be here.
Yeah. If you need great people to build great companies, to make a lot of money, to have nice things. Yeah. Right. And if you can attract people here, then that means that you can build a great company. Right. So Jacksonville is, I'll say it again, the gold medal winner for the most corporate relocations, the most jobs brought in the state that has the most jobs brought in the country, and the city of that wins within that state, within the entire country of most corporate relocation. I wish I said that better. But I think we get it.
Yeah.
I think we get it. And, you know, that's backed up by a whole bunch of other great stats and rankings. I mean, we can just kind of like run over this, but actually I can barely see this. Can you see it?
I can't really see it too well.
But there's a litany of lists that Jacksonville has been a part of, right? As far as like best city to start a business in, city for job seekers in the United States, top 25 best places for young professionals, top 10 biggest boom towns, top city for new residents in 2022, fastest growing metro in the state, right? Like it's got all these lists. It's one of only 5 supernova cities that the Urban Land Institute says. And this is by Travel and Leisure, Forbes, Money Geek, the Business Journal, the Wall Street Journal, Zillow, right? Like all these honors being bestowed to Jacksonville because of these statistics. And then you look into the micro and you see this Winn-Dixie Center that JWB built in Arlington in one of its core neighborhoods. You want to tell me more about this?
I do. And you were there that day when we opened it as well. I was sick. I couldn't be there. So I'd love to hear your perspective of actually being there. But about 5 years ago, JWB saw an opportunity for us to improve the quality of life in one of our core neighborhoods and to improve the investments for our clients over the long haul. And this was a major undertaking. It was called the Town and Country Shopping Center. It had fallen into disrepair, and it is the thoroughfare from downtown Jacksonville into Arlington. Arlington is one of our 4 neighborhoods, and many of you own homes there. And for everybody who's on the summit, we are going to pass by this example of what I talked to you about right now. But we saw this opportunity. We thought this could be a big win for the community. We thought this could be a big win for our clients, and over a long time, JWB would win as well. We got into this project. It's the first time we ever have renovated a shopping center. And I'll tell you, we got in and really learned a lot through this experience, right? Way over budget, way over timeline, all of that good stuff, right? But that stuff doesn't matter because we completed the project, and what we've done for the community is incredible. So 17 years ago, Winn-Dixie was occupying the anchor spot in the Town and Country Shopping Center. We got in there. It's now called College Park. And guess who we were able to convince to come back to take up the anchor spot? None other than Winn-Dixie. For 17 years, Arlington has been a food desert. There hasn't been grocery stores in Arlington. And Winn-Dixie came back because of this investment by taking this shopping center that had been fallen into disrepair. And they said, this is where we want to be. But you know what else they did? They looked at all of those numbers and those metrics of those rents that have gone up, the population growth in Arlington and in downtown. And they said, this is a great investment for us as well. It's created over 100 jobs right in Arlington, great paying jobs to help improve the quality of life for your residents. So that's pretty cool, but I have an even deeper level to the story.
Go ahead.
So we also partner with the Boys and Girls Club, and our team mentors folks from the Boys and Girls Club. And we have this incredible group of young adults that we've been able to have an impact on. And one young lady said to our team, the person who is mentoring her, hey, you know what? I'm so excited about this new Winn-Dixie opening. You know, I think I want to go and apply for a job there. And my teammate, Melissa, who you all have met before, Melissa Gillespie, a director of property management and leasing, she said, let me make a call. And so we were able to connect the powers that be at Winn-Dixie with this young lady, an aspiring young woman looking to make something of herself. We were able to connect the dots. Now she is one of those 100 employees working at Winn-Dixie, sort of completing the circle here and showing how, because of this investment, your investment, which helps us make these types of investments, we're able to make an impact. We're able to change people's lives. And this is one of many things that is going to be happening in Arlington, and a lot that's happening in downtown Jacksonville as well. So this is one example of the type of impact you get to have by being a JWB investor, and ultimately your investment performs better by these types of stories as well.
You said it, man. I was there, and it was a really special day because I got to go there, and then we went to the announcement of the Pearl Street District,
right,
which I was at as well. And that was like a big highfalutin thing. But I think I remember calling you and be like, yo, man, I've never been more excited to be part of JWB and part of this story, because that Winn-Dixie Center, like going from on the street, there was I was just showing like a highlight video of the whole thing. And I don't know if you all noticed, but there was a line of people. This was like a Wednesday morning at 7 in the morning, a store opening for a Winn-Dixie. There was a line around like the block of like the shopping center of people waiting to get in. And I was able to talk to those folks. And they were just like, we haven't had a grocery store accessible to us in this neighborhood for years. They were so excited for it. The jobs, the ability to just like pick up milk on the way home, to be able to feed your family and to not have to like go through a hard time, not have to buy it at a convenience store, to be able to buy fresh produce,
Right.
you know, all the things that you need. People were super excited about it. And it was just this like beautiful economic flywheel of it. And one of the, you talk about the job created for the Boys and Girls Club. The guy that really stood out to me was the superintendent of the project.
Oh, yeah.
Who I've talked to you about. This guy, fascinating dude. I was able to have like a 20-minute conversation with him. This guy was living on the west coast of Florida, and he had saved up a bunch of money to like open up a coffee shop in like Naples or something like that. When he came here and started working on this project, he said, forget it. He wanted to open his coffee shop there. And right in that same shopping center, he's opening up this coffee shop that is like on the way into downtown, where he's also going to be printing plans. Like he's going to like niche into like this whole construction industry that's going down there. And he didn't just stop there. There was a bait and tackle shop right next to the coffee shop. He ended up buying that guy out and going all in on this shopping center because he sees it. He was telling me stories about how when he first got there at night, they'd show up and they would, you know, when they were opening, there was all these broken bottles and all these different things that were happening. And there was all this like gang activity that was happening, like on the corner of that parking lot. He went out there and was like, this guy's like an ex-special forces guy. So fearless.
Right.
Obviously, he goes out there and he goes, who's the leader here? And everybody's like, whoa, what's up with this guy? Right. And like the leader of the gang shows up with a gun in his hand. And he's just like, what's up, man? You want to kill me? And he's like, no. Listen, man, I'm just here to tell you that I'm here to build this thing. Right. This Winn-Dixie, your community hasn't had a grocery store in a long time. And if you guys gathering around here is going to slow it all down, it's going to create all these disruptions, you might not end up getting this thing. And go home and like ask your wife, ask your mom, ask your grandmother, like how important this thing is to this community being here. And I'm telling you that right now, like if you guys don't let this happen, you might not get another chance at this, right? Because all the numbers are here, all these things are happening. And if this gets disrupted by the activity happening around the neighborhood, you might not get another shot at this. That guy came back the next day, sat down with him and goes, you have our protection here. You know, like nobody's going to bother you. Make this thing happen. And the whole community rallied around this center because the Winn-Dixie was so crucial and is so desperately needed by those folks. And again, it's a story of an economic flywheel.
Wow.
You guys investing in all these properties downtown, you know, in Arlington and investing in downtown made you go out there and like restore this like strip mall that didn't have a grocery store. You went out and brought a grocery store in, you invested in all of this. And now this like win-win-win has become like the ultimate community staple of everybody across socioeconomic barriers.
I didn't know that story.
It's incredible.
You know, but I think what this is doing is, you know, it's creating hope, right? It's creating hope in our communities.
Yeah.
And that's not something you can put a price tag on. And you all are a part of that. You know, everybody who has invested with us has given us the ability to go out and do some of these things. And these things are being done not for a return on investment in the short run. This is about community building. It's about making sure that your investments are taken care of. It's about elevating the residents that we have in our community. And later on down the road, JWB will be fine. But that's the type of impact that we want to make. After 18 years in business, that's what gets us motivated.
Love it, man. Love it. So again, answering the question, rents have gone up 27% in the last 3 years. Is this party here to stay? And is this a party that is good for the community? I think the resounding answer is rents are going to continue to go up because Jacksonville is in the path of progress and it's got the perfect economic flywheel happening, which means that even the folks that are right now the most affected in the short term, because 27% in 3 short years is a lot, they are also in the path of progress. And this thing being done the right way is something where the investors that are putting their money into it are going to win. but they don't have to win thinking that somebody else is losing. We're all
Exactly.
winning here.
Exactly. I think that's so critical. I hear that over and over from our investors because of the quality of people that they are. Not only do they want to do well, they want to make sure that others are doing well alongside them. It's not at the disadvantage of somebody else. And stories like this help to illuminate how that's possible. And I think it really, really matters.
Love it, man. Love it. GC, good job today, buddy.
Yeah, man. This is great, man.
Yeah, good work. And to our community, I know we went super long. We just kind of got really passionate. I didn't even realize it's 1:48 right now.
Time flies when you're having fun.
Time flies when you're having fun. You're talking about something you care about, but also when you're surrounded by great people, asking great questions, being a part of this conversation. We never take it for granted that you just took an hour and a half out of a Thursday, middle of the workday, to be here and be part of this, that you're taking time out of your life to come to Jacksonville February 16th and 17th to hang out with us. I promise you're going to get the best out of us. So go to jwbsummit.com, sign up for that thing, get on the waiting list, see you there in a couple of weeks. I'm just really, really excited. And Tuesday, we're having a different conversation.
What are we doing on Tuesday?
Tuesday, I don't know if you've noticed, but we're in an election cycle.
Oh, yeah, that's right.
And in every election cycle, things get heated. And the conversation around Social Security is something that we really need to have. So we're going to talk about Social Security in the election cycle, the state of the American retirement, and how Americans are really failing at retiring and what it all means. So we hope that you join us on Tuesday to have another really deep, really passionate conversation about some really, really important stuff in our Not Your Average Insights, where GC and I are going to go back and forth with you on that conversation. And from now till then, I already saw the early bird say it in the chat. What do you think, man?
Don't be average.
See you Tuesday.